Hi, I'd like to introduce Chris McAlpine, who is the co-founder of Context Capital, who we at Securitas have engaged as our asset consultants. Most recently, Chris was the Senior Investment Analyst at WA Super. You may recall a few weeks ago, we sent an email out asking all our clients if they had any questions that they'd like to ask our asset consultants. We had a great response, and today we've picked 4 of those to ask Chris. How do rising interest rates affect our portfolio?
The area where rising interest rates most obviously affect investment portfolios is in the bond component. Interest rate rises and bond prices move inversely to each other. By that I mean, when interest rates rise, bond prices fall, and that's what we've seen this quarter. Interest rates rose steeply over the quarter as central banks raised them to try to fight off inflation. That's had a significant negative impact on bond prices. So Australian government bonds over the quarter, so from January to March 2022, fell by more than 6%. A global portfolio of bonds fell by almost as much. So this is the primary area where those rising interest rates negatively affect our portfolios. The alternative investments in your portfolios have been specifically chosen to be less sensitive to what happens with interest rates, and that's been the case over the quarter. Property and infrastructure assets are more of a mixed picture as well. Over time, property and infrastructure asset owners are able to pass through inflation to their end clients, which means that rising inflation can actually help boost the prices of infrastructure assets over time.
How often are investments changed in our portfolio?
In a more normal market environment, we typically look to rebalance your portfolios on a quarterly basis. So every 3 months, we do a check-in to make sure that every one of the underlying individual strategies in the portfolio is roughly at the weight that we want it to be at. And if things have moved out of line because certain elements of the portfolio may have grown faster than others over that quarter, or there may have been something that didn't quite work over the quarter, we generally just re-weight everything so it comes back towards our target. Over periods of heightened market volatility, of which the last quarter was one, we will revisit this slightly more frequently so that we can take advantage of any opportunities to rebalance towards target weights and just make sure that everything is staying on track.
What impact and/or strategies in place to address climate change? And are returns being sacrificed with the move away from the lucrative fuel investment?
The team at Securitas believe that addressing climate change presents an opportunity for investors, and so we have a number of investments in your portfolios that are specifically designed to either help the transition away from oil and gas investments, or at least screen out investments that are contributing to climate change. Securitas has investments across both their bond and equity portfolios that are specifically aimed at positively impacting climate change outcomes. The global share portfolio in particular has a slice which is dedicated to companies that are making a positive impact in the world. Part of that will be through addressing climate change, among a whole host of other positive contributions that can be made towards things like the United Nations Sustainable Development Goals. However, this does not mean that there can't be temporary events, such as the war in Ukraine, that can cause this trend to reverse for short periods of time and lead to the outperformance of things like oil and gas in the short term. The pressure put on Western economies by Russia's invasion of Ukraine is an example of this, as it has caused oil and gas prices to spike, leading to outperformance over the last 3 months for these older style economy stocks. However, we do not believe this detracts from the long-term trend towards electrification. So in summary, we would argue that over the very long term, we are not sacrificing any returns from investing in an ESG or green-friendly way.
Can you please talk about the market correction in the USA and the increase in supply of US dollar, caused by a rise in interest rates due to the Fed trying to head off inflation?
As we record this video, stocks in the US have already sold off significantly. The NASDAQ in particular has entered bear market territory, meaning we've come down by more than 20% off of the recent highs. While it's always difficult to look back and say exactly what caused the crash, rising interest rates to fight off inflation have certainly been a factor there. Whether or not rising inflation and interest rates push the US economy or the broader global markets into a recession remains to be seen. We believe that inflation is likely to remain structurally higher, and therefore central banks will have to continue to raise interest rates to help fight it off. Whether this action by banks tips the US or broader global economies into a recession is something that remains to be seen. However, we do believe that it is likely to continue to put pressure on share and bond prices over the short and medium term.